Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. We've recently published a quarterly investment view report detailing our macro investment strategy and outlook for various asset classes including equities, fixed income, alternatives, and currencies. In this episode and the next few, we'll present our thoughts on the outlook. The key question to start with is a recession inevitable? Regular listeners of this podcast would be familiar with our view that while the recession risks have certainly risen, a recession is still not a given. At the same time, we've been saying for a while now that the global economy is likely to experience an asynchronous mid-cycle slowdown. A mid-cycle slowdown typically follows a period of sharp economic rebound that comes subsequent to a recession. After experiencing robust growth, the economy tends to slow and market participants tend to extrapolate such a slowdown to a recession. Uncertainties around the macro outcomes rise during the slowdown phase. In response to this, financial markets embed the uncertainty premium and turn volatile. However, as the macro cycle normalizes, uncertainty should start to diminish and provide a clear path for financial markets. Talking about uncertainties, there are a range of those now, and these relate to inflation, growth, virus, geopolitics, and the central bank policy. While markets were fixated on the persistent and elevated inflation for most part of the first half of 2022, recent weeks saw more focus on rising recession risks. At the interplay of the inflation growth is the monetary policy. Central banks across the world are sounding more hawkish. But markets have paid utmost attention to the US Federal Reserve's monetary tightening. In the context of the US monetary policy turning restrictive, we find the 1990s template as more relevant. Following the 1991 recession, the US economy rebounded quite strongly and the Fed appeared to be behind the curve. Nevertheless, quick front-loaded rate hikes helped the US Fed to bring down inflation without causing a recession. Whilst there are differences between now and the 1990s, there are also similarities. Like 2022, 1994 was also a midterm election year under a first-term Democratic president whose approval rating was falling and political risks were elevated. Equities wobbled all through the year in 1994 before ending mildly negative. With capacity utilization remaining elevated, the Fed delivered rate hikes to cool down demand as supply and labor shortages persisted. After all, 1994 was when the Fed last delivered a 75 basis point rate hike before repeating the act recently. Recession fears rose sharply as a result in 1994, yet political fears subsided after the midterms delivered a gridlock. GDP growth slowed in 1995 before re-accelerating in 1996. Inflation stayed in a range before decelerating in 1997 and 1998. Equities rose every year between 1995 and 1999. Going by the 1990s experience, a soft landing is possible and a recession is not inevitable when Fed normalizes its policy. Yet, it's worth remembering what Mark Twain told us. History does not repeat itself, but it often rhymes. Taking the rough with the smooth, we think it is prudent for investors to think about macro outcomes using a scenario-based approach. As such, we define three scenarios here: base case, worst case, and the best case. First, base case scenario with a probability of more than 50% is a benign scenario under which inflation starts to cool from elevated levels, Fed does not pursue an overly restrictive policy, and the economy manages to soft land. This is similar to our mid-cycle slowdown thesis. Under this scenario, risk assets are likely to recover while bond yields are likely to fall. Second is a worst-case scenario with a probability of 40%, which sees the US economy falling into a mild recession as the Fed focuses on fighting inflation. Under this scenario, risk assets are likely to have further downside. Safe havens including sovereign bonds, gold, and the US dollar are likely to do well. Third is a best case scenario, has a probability of less than 10%, but here inflation falls precipitously, giving Fed the scope to not pursue an overly hawkish monetary policy. This should in turn help economy avoid a significant slowdown. In this scenario, risk assets are likely to recover above their previous peak. Safe havens are likely to underperform. Going by the weighted average of these three scenarios, we remain neutral equities and alternatives, underweight fixed income but with increased overweight and duration in US Treasuries, and keep cash at an overweight to deploy when the opportunity arrives. Thanks for listening. For more information on what was discussed on this podcast or to access our latest quarterly investment view report, please reach out to your contact at ADCB. You can also find more information on our website at www.adcbam.com. Stay tuned for more episodes where we discuss Q3 and H2 outlook for individual asset classes. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.